In this video, traders, I want to talk about risk management red lines. In other words, lines that you should never cross for your risk management. Stay tuned. Hey traders, warm welcome to you. Alright, so there's rules and there's rules, right? And what do I mean by this? Now, you should have rules that you just will 100% stick to. And I actually think that, as a newer trader, all your rules should stick to. However, you can bake in some flexibility to your rules. Now, be careful you don't allow yourself a get out of jail free card and go, well, I can break any rules. But you can, I believe, in your trading plan, give yourself flexibility with some rules. Now, there's red lines and boundaries, and they should frame your trade. In other words, hey, when my trade passes my filter criteria, I'll talk about filters and triggers loads. You guys know that's the way I approach things. I put it through a filter. What comes through, then if it triggers, I'll take the trade. If it doesn't trigger, goes back out of the filter. But you then might have some flexibility, like, hey, very strict filter criteria. It's got to be this, it's got to be this, it's got to be this. But I can pull the trigger in this range. So in this range under low or above a high, or on this candlestick shape, or this price action, or something. I believe there's some flexibility there. Now, risk management are rules that should be so ironclad with the door locked and bolted and shuttered and welded shut that you should never, ever, ever break them, because they're the one rule that has the potential to really devastate your account. Listen, if you pull the trigger a little bit too early, if you take a trade a little bit too late, if you kind of do little things like this, they're not going to be detrimental to your account. You can get away with them. You want to try to train yourself to not do that. You obviously want to try and be as strict as possible. But in the heat of the moment, sometimes if you're day trading, you're going to miss a fill. You're going to be a little bit late to the market. You're going to get a little bit of a bad fill. You're going to sometimes do this. That's not the end of the world, as long as you're trying to steer the ship in the right line. And when it goes off course, you bring it straight. But what is potentially the end of the world when you're day trading is if you start to break risk management rules. Those are rules that should never be broken. And what do I mean? So risk management, like how much I'm risking per trade. If you suddenly start risking more per trade, that's immediately a sign that you're one of two things. One, feeling overconfident, which there's no reason you should be anywhere near your trading station if you're feeling overconfident, because you just know that's a recipe for disaster. Or two, trading out of revenge or frustration. I want to get the money back. I've lost money. If I double my size, I can get it back even quicker. Both of those are bad scenarios. So by the very nature of you wanting to increase size in your trade on a whim, not through a trading plan. Remember, if you've got a trading plan that says, hey, after 3 trades, I can increase it, 4 trades, whatever, that's fine. But any deviation from the plan from a position size perspective is immediately a red flag that says, hey, you're trading from one of these two areas and neither is a good position to be in. If you're changing the amount that you're prepared to risk on a trade on a whim within like a couple of milliseconds worth of consideration, that's not a professional approach. You know that yourself. If you were managing a fund and you were about to execute, and at the last minute before you sent the order through to your dealers to fill, you went, you know what, let's quadruple it. I think you probably wouldn't last long in the fund. And you just think about what you're doing there. So that's one thing, position size. Number two is and that obviously comes with the risk per trade. Number two is if you're day trading, the risk you're going to take in a day. This is one of the things that should be so locked and unmovable that it's like the strongest thing. It should be the real priority. Because again, if you break this, you are in big danger of blowing up your account. You're in big danger of taking some huge steps back. You can take one smash to the face with a bad day. You can take a couple, you can take 3 days in a row. You can take them because ultimately you'll kind of regroup and you'll recenter and you'll push back forward. But what you can't take is a devastating knockout blow. You can't take 10 times more than you expected to lose in the day, or 4 times or 5 times or even more. I've heard stories, and guys, I've been there. I've been there in my early days of day trading. I'd say I'm going to risk this per day, and then end up getting hammered and trading on tilt and having such a bad day, and then feeling disgusted with yourself for doing it. Maybe you have to go through it. Maybe you have to learn the hard way. But this kind of wipes out more people than others. But if you've had it and you've got away with it, now's the time to take grip of it and go, right, you know what? I am no longer going to risk more than I've allocated in a day. That's it. That's my number one rule. I'm not going to trade more size than I should. I'm not going to risk more than I allocated in a day. Because once you start going past that, again, if we go back to the initial point, The initial point is saying, hey, if you think in that millisecond that you should be taking more risk, you think you're in a better place to make a decision than you are when you're relaxed and you look at the market and you're coming a trading plan. You already know that you're either overconfident or you're panicking or you're frustrated or any of the other things. You know that's the case. And so be very mindful of that. Be very, very mindful. And the third and final thing, guys, is just a kind of a natural progression of the daily risk of saying, what's my weekly or quarterly risk? Because there's no point in saying I've got a daily risk of $500, for example, and you go 500, 500, 500, 500, and before you know it, you've done 2 weeks, you've lost $2,500, and things aren't looking good for your account because you only had $10,000 account. All of a sudden, you've lost a quarter of it, and you need to kind of extrapolate things out and go, right, I'm prepared to lose, for example, 1,500 in the week, 500 a day. So if I lose 1,500 on my first 3 days of full losers, I'm out for the week. I need to regroup. So it's an extension of the trade risk, the day risk, and then you've got a week risk, or if you're kind of a higher time frame, maybe do a month or maybe do a quarter. It's very important, guys, that you protect your risk capital. We have to face the fact that we are never going to be good traders all the time. We have spells where we will not be trading well. That is an absolute guarantee. Some of the best funds out there, we've got the algo fund like Renaissance, had spells where they're not doing so well. Paul Tudor Jones last year was seeking help to kind of reinvigorate himself because he was having some sort of some drawdown. I know some of the great traders who just have times when they don't do very, very well. I know myself, I had periods where I just not in tune with the market. Things aren't going as I want. So it's always going to be a situation where there will always be a situation, should I say, where you won't be doing as well, regardless of the level you're at. So it's important now to know when to reduce the damage that does before it happens, and understanding, hey, I'm not always going to be on form. I'm not always going to be making money. So when I get to a point where I'm not making money, which is guaranteed, how do I stop the damage? How do I limit it? And it is by reducing that size, making sure you're strict with your size, having strict limits on your daily risk if you're day trading, having strict limits on your kind of weekly risk or monthly risk if you're day trading again, or if you're trading a slightly higher time frame, and having those three like a triple lock that you do not deviate from. Other things ultimately don't matter. They really don't. You can take a bit of a trade that is bad entry. You don't hold a trade as long as you should. You didn't trail it when you did this. Ultimately, you can work on those, but you know your capital won't ever be too devastated because you're sticking to your risk parameters. So focus on those, and you'll be in the game for a long period of time, and you'll be in a good position that when you are trading more size and when things are swinging more wildly and you're getting these 50k days, 100k days, or whatever level you're aspiring to trade to, then you know that, hey, it's not going to wipe me out anyway because I was trading very, very disciplined and very good with my size when they had a 10 grand account. So you get the point. Anyway, guys, hopefully that's helped. Keep an eye on the risk because it's the one thing that matters the most more than anything. Take care. Bye-bye.